694 corporate bankruptcies in 2024, 14-year high. Forever 21, Nikola Corporation, Joann Fabrics, Hooters, 23andMe, household names collapsing, and 2025 is already worse. First quarter alone, 188 bankruptcies. That's the highest Q1 since 2010, when the economy was still reeling from the Great Recession. $8.45 trillion in corporate debt. Interest rates at 20-year highs. Debt maturing that companies can't refinance. This isn't a financial crisis. This is a debt maturity wall. And I'm going to show you which sectors collapse next. March 20th, 2020, the Federal Reserve drops interest rates to near zero, 0.25%. Pandemic response. Corporations borrow record amounts. $2 trillion in new debt issued in 2020 alone. Another $1.8 trillion in 2021. Cheap money. Historic low rates. Companies refinance existing debt, take on new debt, fund expansions they couldn't afford before. The logic was simple. If you can borrow at 2%, borrow everything you can. That debt had 5-year terms, due 2025 through 2027. March 16th, 2022. The Federal Reserve starts raising rates, 0.25% up to 0.5%. By July 2023, 5.33%. 20 fastest rate hikes in 4 decades. They held rates there through December 2024. The reasoning? Fight inflation. The consequence? Companies that borrowed at 2 to 3% during the pandemic now face 7 to 8% refinancing costs when that debt matures. The math breaks, interest payments double. Revenue doesn't, cash flow can't cover debt service. Bankruptcy becomes the only option. Here's the data. 694 corporate bankruptcies in 2024, according to S&P Global Market Intelligence. That surpasses 635 in 2023 and 638 in 2020, the previous 10-year high during the pandemic. December alone, 61 filings, the largest single-year total since 2010, when 828 companies filed bankruptcy in the aftermath of the Great Recession. This wave isn't slowing, it's accelerating, and the worst sectors haven't even hit yet. But here's what mainstream business media won't tell you. This isn't random economic weakness. This is mathematical inevitability. Between 2020 and 2021, corporations issued $3.8 trillion in new debt at average rates below 3%. That debt matures on a 5 to 7 year schedule, which means the peak hits 2025 through 2027, right now, with refinancing rates at 7 to 8%. If you want to understand why household name companies are collapsing, this is the financial mechanism they're not explaining. If this kind of debt structure analysis is new to you, you're in the right place. We expose the economic systems behind corporate collapses every week. Hit subscribe. Let's run a simple example. Company borrows $100 million in 2020 at 2.5% interest. Annual interest payment, $2.5 million. Manageable. The debt matures in 2025. They need to refinance. New rate, 7.5%. New annual interest payment, $7.5 million. Same debt, triple the cost. If the company's cash flow stayed flat, they just lost $5 million in annual profit to interest expense. And revenue didn't stay flat for most companies. It declined. Stop. Before I show you which sectors are collapsing next, you need to see the debt numbers. Credit-rated non-financial US corporations carry $8.45 trillion in total debt as of Q3 2024. That's a quarterly record according to S&P Global. Interest coverage ratios, the ability of companies to pay interest with operating income, weakened markedly. For non-investment grade companies, the pressure is acute. These are businesses rated BB+ or lower. Junk bonds, high yield debt. They borrowed heavily during the pandemic because investors chased any return above zero. Now those investors want 7 to 10% yields, and companies can't generate enough cash to pay it. And here's where this becomes personal. If you work for a company that expanded aggressively during 2020 through 2022, opened new locations, acquired competitors, invested in equipment, check their debt load. If they borrowed cheap money to fund that growth, they're facing the same refinancing wall. Your pension fund probably owns corporate bonds from companies on this list. Your 401k likely holds funds with exposure to non-investment grade debt. If you're a supplier to retail chains or manufacturers, you're one bankruptcy away from unpaid invoices. Quick question for the comments. Does your employer carry significant debt from the pandemic era? Type yes if you know they do, uncertain if you don't know their financial situation. Here's the economic system that created this wave. Step 1. Federal Reserve drops rates to 0 during crisis. Step 2. Corporations borrow maximum amounts at minimum rates. Step 3. Fed raises rates faster than borrowers can adjust. Step 4. Debt matures. Refinancing costs triple. Step 5. Companies with weak cash flow or declining revenue can't cover new interest payments. Step 6. Bankruptcy. This wasn't unpredictable. Economists warned about debt maturity walls in 2022. The Fed raised rates anyway. Corporate America borrowed anyway. Now the bill comes due. Send this to anyone who thinks these bankruptcies are just bad management. The sector distribution tells the story. Consumer discretionary and industrials accounted for 199 bankruptcies in 2024. 28% of all filings. These are retail chains, restaurants, manufacturers, businesses sensitive to consumer spending and input costs. Healthcare, 65 bankruptcies, third highest. Why these sectors? They're capital intensive, require ongoing investment, and operate on thin margins. When interest costs rise and revenue declines, there's no buffer. A restaurant chain with 50 locations and 100 million in debt at 7% interest needs 7 million annually just for debt service. If sales drop 10%, the math breaks. The bankruptcy classification matters. Chapter 7. Liquidation, assets sold, company closed. Chapter 11. Reorganization. Company continues operating while restructuring debt. In 2024, 54.5% of business bankruptcies filed Chapter 7. They're not restructuring, they're closing permanently. Another 36.6% filed Chapter 11. Some will survive with reduced debt. Many won't. The distinction matters because Chapter 11 bankruptcies can pivot to Chapter 7 liquidation if restructuring fails. Wait, I know what you're thinking. The Fed is lowering rates now, so won't this improve? Let me show you why 2025 is already worse than 2024. Here's the Congressional Research Service data. 23,107 business bankruptcy filings for the 12 months ending December 31st, 2024. That's a 22.1% increase from 2023. The 694 corporate bankruptcies, that's a subset. Total business failures including sole proprietorships, partnerships, and small corporations, 23,000. The wave isn't limited to big companies. It's systemic across all business sizes. And remember that Q1 2025 data, 188 corporate bankruptcies, already 35% higher pace than 2024. This is why I investigate debt structures. Subscribe if you want to understand which companies are mathematically doomed before the headlines announce it. But we're not done, because Q1 2025 saw names that should terrify retail investors. Forever. 21 F21 Opco LLC filed March 2025 with over 1 billion in liabilities. Nikola Corporation, the electric vehicle maker. Joann, the fabric and crafts retailer, closing all US stores. Hooters, 23andMe. These aren't struggling startups. These are established brands with decades of history. Forever, 21 survived the 2008 recession. It couldn't survive the debt maturity wall, and the quarter isn't even finished yet. Let's talk about the people behind these bankruptcy filings. Forever, 21 employed 40,000 people globally. Joann had 32,000 employees. When these companies file Chapter 11, jobs don't disappear immediately. But wage freezes hit, benefits get cut, store closures accelerate, suppliers stop getting paid. The bankruptcy ripple spreads. A Joann store closure doesn't just affect the 30 employees at that location. It impacts the shopping center's foot traffic, the fabric suppliers waiting on invoices, the pension fund holding Joann bonds. Bankruptcy is an economic contagion event. Cornerstone Research tracked large bankruptcies, companies with over 100 million in assets. Through mid-2024, 113 such filings, 8% increase year over year, 43% higher than pre-2020 averages. Mega bankruptcies with over 1 billion in assets, 17 in the first half of 2025 alone. But the statistics don't capture the community impact when a major employer collapses. Small towns where the factory was the largest taxpayer. Shopping malls where Forever 21 anchored foot traffic. They don't teach debt maturity walls in business school curriculums. Financial analysts warned this was coming in 2022. Corporate executives borrowed anyway. Now you understand the systemic pressure that made bankruptcy inevitable. Have you personally been affected by a corporate bankruptcy? Lost job? Unpaid invoices? Closed locations near you? Share your experience below. I want to document the real economic impact. And here's the part about what's coming. Because 2024 was just the beginning. The debt maturity schedule shows peak maturities hitting 2025 through 2027. We're in month 1 of a 3-year cycle. If 694 companies failed in year 1 with the Fed starting to cut rates, how many fail in years 2 and 3 if rates stay elevated? The Congressional Budget Office projects the Fed holding rates above 4% through 2026. That's still double the pandemic era. Companies that survived 2024 by cutting costs have no more room to cut. I saved the sector-specific projections for last. Consumer discretionary sector. 2008, Great Recession. Retail bankruptcies surged as consumer spending collapsed. 2024, debt maturity crisis. Retail bankruptcies surge again, but for different reasons. Same outcome, different mechanism. Industrial sector. 2009 aftermath. Manufacturing bankruptcies peak at record levels. 2025 first quarter. Industrials account for 32 bankruptcies, most of any sector. History doesn't repeat, but it rhymes. Check your portfolio holdings. If you own retail stocks or industrial sector funds, cross-reference their debt-to-equity ratios against the 8.45 trillion aggregate. Companies with ratios above 3 to 1 are statistically vulnerable. Send this to anyone managing their own retirement accounts. They need to understand debt maturity risk before Q2 numbers get released. Here's the Cornerstone Research analysis. 17 mega bankruptcies in the first 6 months of 2025. Companies with over $1 billion in assets. That's the highest half-year total since the COVID outbreak in 2020. These weren't small businesses that overextended. These were large corporations with professional financial management. They saw the maturity wall coming. They tried to refinance early. Credit markets wouldn't accommodate them at rates they could afford. Remember the 8.45 trillion in corporate debt. Remember the 694 2024 failures. This is how systemic risk manifests. You're witnessing it in real time. The bankruptcy wave isn't speculation. It's documented, measured, and accelerating. Subscribe to track which sectors collapse next before your investment portfolio or employer gets caught in the wave. So let's wrap with accountability. The Federal Reserve raised rates knowing corporations carried record debt loads from the pandemic. They prioritized inflation control over corporate solvency. Not wrong necessarily. But they made a choice. Corporate executives borrowed at 0%, knowing rates wouldn't stay there forever. They prioritized growth over balance sheet strength. Also a choice. The combination created mathematical inevitability. Here's my controversial take. These bankruptcies aren't economic failure. They're policy choices with predictable consequences. The Fed chose to trigger the debt maturity wall to cool the economy. Corporations chose leverage over stability to maximize growth. Both sides knew the math. Both proceeded anyway. Now 694 companies have failed and 23,000 businesses overall filed bankruptcy. Tell me I'm wrong in the comments. Show me the scenario where rapid rate increases don't trigger mass insolvencies among highly levered companies. You can't unknow this debt structure. Every corporate earnings report, you'll look for debt-to-equity ratios and maturity schedules. Every Fed announcement, you'll calculate refinancing costs for vulnerable sectors. What investment decisions will you change now that you understand the maturity wall timeline? What sector should I investigate next? Which industries face the worst exposure in 2026? Most detailed analysis gets featured in the next deep dive. Next investigation. I'm analyzing the $3.7 trillion infrastructure funding gap and how the ASI gave America's infrastructure a C grade while the problem got 43% worse. Same accounting trick we just exposed, temporary improvement masking structural collapse. If these financial system investigations matter to you, subscribe and hit the bell. I expose the economic mechanisms behind corporate failures and infrastructure crises that business media won't explain. Every breakdown, every week. Click here for the infrastructure investigation. Or watch the 68 bridges the NTSB says could collapse next if you missed it. See you in the next financial analysis.